Hello everyone, welcome to EduTap and welcome to today's session. So today it is going to be very important because today we are going to cover the financial stability report that has been recently released by the Reserve Bank of India, and we are going to have a detailed coverage. Okay, that is, we are going to cover most of the part of the financial stability report that is important from your exam perspective, and this is very important for the RBI Grade B examination. Okay, as well as in the NABARD grade A examination in the phase 1 we have seen a question from FSR. It is also important for the SEBI grade A, but it is most important for the RBI grade B examination, and today we are going to have the detailed coverage. I will show you, I will tell you that which data points are important, which you have to cover. Okay, so today we are going to have the detailed discussion, and good morning all of you, good to see all of you here. Let's start with this very important report, but before that do subscribe to the YouTube channel of EduTap and join our Telegram channel, because in the Telegram channel you will get the PDF of the session. Okay, so the PDF you will get in the Telegram channel, and the link for the Telegram channel is provided in the description box below. So let's get started. So first of all, what is FSR? So FSR, it is a report that the Reserve Bank of India releases, and it is a half-yearly publication. Okay, so we have got the edition of Financial Stability Report, the June edition, the June 2024. This is the most recent FSR that the RBI has recently released, and this is the 29th issue of the FSR that has been released. Okay, so now it reflects a collective FSR, the Financial Stability Report. It is not only the Reserve Bank of India that is giving the inputs in the FSR. The FSR, it is the collective assessment of the subcommittee of the Financial Stability and Development Council. That is, there is a FSDC, the Financial Stability and Development Council, whose chairman is the Finance Minister. So Finance Minister is the chairman of the FSDC, and the FSDC, the members of FSDC are the governor of the Reserve Bank of India, the chairman of SEBI, the chairman or the head of the IRDAI, the head of the PFRDA. So you can understand that the head of the regulatory bodies, they are the members of the FSDC, and the chairman of FSDC is the finance minister. Now this FSDC has a subcommittee. The subcommittee is headed by, or the chairman of the FSDC subcommittee is the Governor of the Reserve Bank of India. Now this subcommittee has given the collective assessment in the FSR. So FSR, it reflects the collective assessment of the subcommittee of the FSDC with inputs from all the financial sector regulators, because the members of FSDC, the regulatory head of that are the member of the FSDC, they are also the members of the subcommittee. So the Governor of the Reserve Bank of India is the chairman of the subcommittee, plus the head of the SEBI, the head of the IRDI, the head of the PFRDA, they are members of the subcommittee. Okay. Now it shows the assessment, the FSR, it shows the assessment and evaluation of the subcommittee of the FSDC on the risk to the financial stability of our country and the resilience of the financial system, that how resilient our financial system is. So this is shown by the Financial Stability Report. We are going to discuss it in depth today. Okay, now FSR consists of 3 chapters and a systemic risk survey. So the first chapter is macro financial risk. The second chapter is financial institutions, soundness and resilience, how resilient they are. The third chapter is the regulatory initiatives in the financial sector. We are going to discuss these chapters one by one, and then we will discuss the systemic risk survey. So we are going to start with the first chapter, that is macro financial risk, and we are going to start with the global economy. That what are the macro financial risk that the global economy is facing. So starting with, we all know that there are the geopolitical tensions that are going on, Russia-Ukraine war, the Gaza situation, the elevated public debt. So this elevated public debt, I will show you the data regarding this elevated public debt, and you will be shocked that how high the public debt has become. Okay, so we will see this. But there is also the slow progress in the last mile of disinflation. So disinflation is happening at the global level. That means the inflation is reducing, but at a slower pace. So inflation is reducing from 8% to 7%, 6%, 5%, but at a very slow rate. Okay. Despite these challenges, the global financial system has remained resilient and financial conditions have remained stable. Here you can see that as per the IMF, the economy, the global economy has grown by 3.2% in 2023. And it will grow by 3.2% in 2024 and 2025. So these are the forecast. The World Bank uses a different methodology, and the World Bank has said that in 2023 the global economy has grown by 2.6% and it will grow by 2.6% in 2024 and 2.7% in 2025. Now this is the growth scenario as per the IMF and the World Bank. What is the scenario of inflation? So the goal of bringing inflation down, this is the main goal right now of the monetary authorities all over the world. Like the Reserve Bank of India is trying to reduce the inflation in our country. Similarly, the monetary authorities of different countries, they are also trying to reduce inflation in their own countries. So the goal is to bring down the inflation to the targets, remain the key focus of the monetary policy of the monetary authorities all over the world. Now, although headwinds are being encountered, there are many problems that are being encountered. There is sticky services inflation. So in many countries, the services is having the higher prices. There is the service inflation that is remaining sticky. Elections are happening across half of the world's population. So that is a problem. Why is it a problem? Because when elections happen, different parties for their rallies, they spend a lot. So during the elections, there is high expenditure that is done by the people or by the parties, due to which when you are doing high expenditure, your demand will be high, your inflation or the prices will also start increasing. So when there is high demand, okay, if elections is happening, there is high demand of alcohol, let's say. So alcohol is in high demand, so the prices of alcohol will start increasing, let's say. Or if there is high demand of the stages for the rallies, so the prices will start increasing of these commodities. So due to elections across half of the world's population, there is the high inflation that we are encountering, or the inflation is remaining, like the disinflation is happening slowly, okay. And the recent firming up of the commodity prices. So recently what has happened, that the commodity prices have started to increase slowly and slowly. So besides persisting geopolitical tensions, these are some of the problems. Sticky services inflation, elections across half of the world's population, recent firming up of the commodity prices, and the persisting geopolitical tension is a major problem for the monetary authorities around the world, due to which they are trying to decrease the inflation, but the inflation is not decreasing. That is, disinflation is creating the problem. The last mile disinflation is persisting, and this is creating some problem. Now coming to the debt scenario, that is very important data that has been given by the in the FSR by the collective assessment that has happened. So what is the debt scenario? First of all, there is frantic expansion that has happened of the global public debt. The global public debt has increased in a very fast manner in the recent years and has accentuated the concerns about the sustainability, that how long can we sustain this kind of high global public debt. These worries are exacerbated by elevated interest rates. So as you know that most of the monetary authorities, the Reserve Bank of India is keeping the interest rate high, as well as the other monetary authorities, to decrease the inflation. To decrease the inflation in their countries, they are keeping the interest rate high, because when the interest rate is high, you will take less loans. At the high interest rate, you will take less loans. When you are taking less loans, that means demand will be lower. When the demand is lower, that means prices will start to decrease, okay. So interest rate in most of the countries is kept high. That means at the global level, the interest rates are high. At the high interest rate, there is huge public debt that is being taken by the governments of different countries, or different countries are taking the debt. So global public debt has increased to 93.2% of the global GDP. That means if the global GDP is 1 trillion, 93.2 trillion of the public debt has been raised. So global public debt has increased to 93.2% of the global GDP by the end of 2023. Does it seem sustainable? I don't think so. And when you will see the private data now, you will be shocked that how much public debt or how much debt in total is a percentage of the GDP. So we will see. So this is 9 percentage points above its pre-pandemic level. So you can understand by this line only that it is 9 percentage points above the pre-pandemic level. Now bloated by pandemic era, because during the pandemic era, the government had to spend a lot for the medical services, for the food that they had to provide during the lockdown things. So during the pandemic era, during the COVID situation, the government had to spend a lot of the money on their healthcare facilities, on their food provisions and such. So due to this, the expenditure that the government was doing, the government was taking a lot of loans to do this extra expenditure. So during the pandemic era, there was the expansionary fiscal policies that were adopted. Government was spending too much at that time. Post-pandemic supportive measures, so after the pandemic, there were supportive measures that were provided, such as tax breaks were given, subsidies were given. So this has also led to the high public debt. So government debt, the debt that has been taken by the governments, you can understand that it is 93.2% of the global GDP. So that is, if the global GDP is 100 rupees, 93.2 rupees is the loans that the government has taken. Okay. Now, alongside the mounting public debt, the private debt also remains elevated. If you see, the public debt is at the US dollar 97.7 trillion. Okay. So the public debt, the government debt, we can say, or the sovereign debt, it is around 97.7 trillion. While the private debt, it is 153.7 trillion. It is the private debt, it is around 153.7 trillion. When our global GDP is around 105 trillions or 106 trillions, you can understand that the government debt is around 97.7 trillion, while the private debt is around $157.7 trillion. That means the total global debt is around 239.9% of the GDP. So you have to remember the percentages, or you have to focus on the percentages, that the debt that is taken by the public debt, the global public debt, it is 93.2% of the GDP. While if we see the total global debt, it is around 239.9% of the GDP. That means if the GDP is 100 rupees, the global debt is 239.9%. Does it seem sustainable? Because to me, when I was reading this data also, it didn't seem sustainable. That how why the GDP, the global GDP is around, let's say 100 trillion, sorry, it is around 105 trillion, 106 trillion, while the global debt is around 251.4 trillion. That's why if the global GDP, the global debt is 239.9% of the global GDP. Is it clear? Is it clear? FSR, we are studying the FSR now, Financial Stability Report. Are you able to understand this? Is it clear? Yes or no? Give me a thumbs up if it is clear. Clear? Okay. So this is the idea that the public debt has increased to 93.2% of the GDP, while the total global debt has increased to 239.9% of the GDP, and the FSR has clearly mentioned that the threat of a looming debt crisis cannot be overemphasized. There is a vicious cycle that has been created of the debt, and that is a major problem. And the major thing is here, you can see worryingly, the two largest economies in the world, US and China, are leading the increase in the global debt. That means they have taken immense amount of the debt. So a question can come from this point directly, that which are the two major economies that have taken the immense leading in the increase in the global debt. So that is US and China. It's not some emerging economy, it's the developed economies that are creating the problem now. Okay, so the threat of a looming debt crisis cannot be overemphasized. The fiscal consolidation took a backseat. No one cared about the fiscal consolidation in the 2023. Fiscal consolidation means fiscal consolidation. What does this mean? This means that you have to decrease your borrowings, you have to decrease your fiscal deficit. Fiscal deficit means it is the total expenditure minus total receipts, total expenditure of the government minus total receipts of the government excluding borrowing. So that means if the total expenditure is 100 crores while the total receipts of the government is, let's say, excluding borrowing is 80 crores. So this is the total receipts of the government excluding borrowing. So that means fiscal deficit is 20 crores. So what is the requirement of borrowing by the government? because total receipts of the government excluding borrowing, so only borrowing is the thing that is left with the government to cover this extra expenditure. So the fiscal deficit that is of 20 crores, this is also the total borrowing requirement of the government, that is 20 crores. That means if the government is reducing the fiscal deficit, the government is reducing its borrowing requirements. And how the government can reduce its fiscal deficit? By reducing its expenditure or by increasing its total receipts other than the borrowings. So that is the idea. So fiscal consolidation has taken a backseat. That's why you can see that so much of the debt has been taken by the government to do the extra expenditure. The global fiscal deficit increased to 5.5% of the global GDP on an average, a rise of 1.6 percentage points from the previous year. So if you see that the fiscal deficit, that is the total expenditure minus total receipts excluding the borrowing. So the fiscal deficit at the global level has increased by 1.6 percentage from the previous year, and currently it is standing at 5.5% of the global GDP. Primary deficit. Now what is the formula of primary deficit? Yes, Priyanka. So now what is the primary deficit? The primary deficit, it is the fiscal deficit minus interest payments, okay. So primary deficit, it is the fiscal deficit minus interest payments. Now you know that the interest is very high currently in the global level. So the interest payments that the governments have to give is also very high. So you can understand that the interest in the global level is very high because all the monetary authorities or major monetary authorities are keeping the interest payments or the interest rates very high to lower the inflation. So when the interest rates are very high, so interest payments will be very high. So the primary deficit has actually decreased by 2 percentage points. So fiscal deficit has increased by 1.6 percentage, but because of the increase in the interest payments, the primary deficit has decreased by nearly 2 percentage points. So I hope you are able to understand that because of the increase in the interest payments, the primary deficit has decreased, but that is not good for our country because our country has to give the interest, right? Yes, very good, Jyoti. So this is the idea. I hope this is clear. Now the last point is that the sharp rise in global public debt. The public debt has increased sharply at the global level. The private debt also, you can see it is quite high. Especially among the two largest economies, that is US and China, the global public debt has increased a lot. Now this poses a significant spillover risk to the emerging market economies. You can understand that if the US is falling or if there is a problem that is created in US, it is going to affect the other countries like the recession, the Great Recession that we have seen in the 2007-2008 when the problem started from US and spread to the other parts of the world. Similarly, this time also there is a problem that is looming. There is the mounting public debt, that is a looming debt crisis, that we can say that there is a threat of the looming debt crisis. So this is a major problem. Okay. The low income and the low rated countries are particularly vulnerable because they are low rated. That means they have to pay more interest payments also. I hope this is clear. Yes, Jyoti, we will come to the domestic data. Do not worry about it. Is it clear? Okay. Let's move forward with the domestic economy. In the uncertain international economic and financial environment, the Indian economy is exhibiting resilience and remains the fastest growing major economy. India's contribution to the global growth is rising and currently stands at 18.5% in the 2023-24. Okay, so this is a major point that you have to remember. Now the real GDP, as per the Financial Stability Report of June 2024, the real GDP has increased by 8.2% in the 2023-24. Now this is the data from the provisional estimates, that is the most recent estimates. As per the most recent estimates of the National Statistical Office, the real GDP has increased by 8.2% in the 2023-24, up from the 7% in the previous year. Despite muted private and the government final consumption expenditure. So the private consumption expenditure, that is the consumption expenditure of the households, this is growing but at a lesser percentage. Similarly, the government final consumption expenditure has also decreased in the growth perspective. External demand conditions acting as a drag. So external demand conditions are also not good because the global growth is not much, or the different countries are facing different problems. So the external demand is also not good. But because of our Fine consumption, the consumption is still at the growing phase, though it is growing at a lesser rate, but still it is growing. The investment in our country is good, the manufacturing in our country is good, due to which there is the real GDP has increased, that you can see. Okay, the Monetary Policy Committee has projected the real GDP to grow by 7.2% during the 2024-25. So this is the recent estimate of the Monetary Policy Committee, that they are expecting the real GDP to grow by 7.2%. Okay. Now coming to the inflation. So this inflation data you do not have to remember, but this is from the understanding perspective. Why you do not have to remember this inflation data? Because this is for the May 2024. So the recent inflation data that will come will be for the June, July, August. So that you have to focus on. Okay. So if CPI inflation has eased to 4.7%, that is, see, what is the CPI target? In our country, the CPI inflation target is 4% plus minus 2%. That means we want our CPI inflation to be around 4%. It should not go below 2% and it should not go above 6%. So 2% and the 6% is the range of the inflation. Okay. So CPI inflation has eased to 4.7% in May 2024 from the 5.7% in December 2023. So you can understand that the CPI inflation in our country is decreasing now, and it is near to the 4.7%, that is, it is near to the 4%. So the CPI inflation is 4.7%, that is near to the 4%, but still we want it to be closer to the 4%, but its near-term trajectory remains vulnerable to the volatile food prices. So the CPI inflation is 4.7%, that is near to the 4%, but what will happen in the future, in the coming months, we do not know, because the food prices are quite volatile. Food inflation has increased to 7.9% in May 2024 from the 7.6% in January 2024. Now, if you see the core inflation, that is the inflation excluding the fuel and food, that is the inflation. The core inflation is the inflation that is excluding the food and fuel prices, that is excluding the volatile prices. So this is witnessing a sustained decline, and it is eased to 3% in May 2024, its lowest level in the current CPI series, that you can see that the core inflation is declining, and that is good. Okay, so core inflation is declining, but the food inflation is very volatile, due to which the inflation is right now in May 2024 was at 4.7%, near to the 4%, but we do not know that what will happen because the food prices are very volatile. Now, Neha has a question that what is the looming debt crisis? So, see, the debt, the global debt, it is a very high percentage of the GDP. So when the debt is a very high percentage of a GDP, there is a threat of looming debt crisis. Debt crisis means now the countries might not be able to return their debt. So in the countries all over the world, the financial markets might start becoming very volatile, and many of the countries will start failing in returning their loans. That will create the debt crisis, that will start the crisis in the different parts of the world. So there is a threat of looming debt crisis because the global debt as a percentage of GDP is very, very high. Okay, I hope it is clear. Now coming to the external sector, the domestic economy, external sector. So first of all, these data you have also seen in the balance of payment statement that the RBI recently released, that the resilience of the external sector has supported the India's overall macroeconomic stability. The India's current account deficit, in the current account, I hope you know that the current account, it is the trade in goods, the trade in services, and the transfer payments, that is the remittances that are coming in the country. So trade in goods have remained in deficit, but the merchandise deficit or the deficit in the trade in goods have decreased, while there is the surplus in the trade in services, as well as there is surplus in the transfer payments. So there is still the deficit in total in the current account. There is the deficit that is happening, but the deficit is lower than the previous year because in the trade in goods the deficit has reduced, while in trade in services and transfer payment the surplus has increased. So here you can see that if you see for the trade deficit, the trade deficit is lower than the previous year. The trade deficit is lower than the previous year, while the net invisible surplus, we can say surplus. So trade in services trade in services and the transfer payments, they are known as invisible trade. They are known as invisible trade. So there is surplus in the invisible trade and the surplus has actually increased in the invisible trade. I hope this is clear. So what is happening, that the resilience of the external sector has supported the macroeconomic stability of our country. The deficit in the total current account, the current account deficit has decreased from 2% in the previous year to 0.7% in 2023-24. I hope this is clear. Now so this is the major idea, that the current account deficit has decreased to 0.7% of the GDP from the 2% of the GDP in the previous year. Now the moderation in the trade deficit has happened alongside sustained buoyancy in the services exports, that is having a surplus, as well as remittances are also good in our country. This has led to the current account surplus of 0.6%. So 0.6% of the surplus has happened in the current account. 0.6% of the GDP, this much of the surplus has happened in the current account in the fourth quarter of 2023-24. So you can see that even the trade deficit that was decreasing. So in the fourth quarter, so for the whole financial year of 2023-24, we have seen the current account deficit. Okay, so if we take the data for the full year, we have faced the current account deficit that is lower because of the high trade in services and high transfer payments that are coming to the country. But in the fourth quarter, if you see for the fourth quarter, in the fourth quarter, we have seen the current account surplus. So for this quarter, that was the January to March 2024 wala period. So in that we have seen the current account surplus because the trade in services and the transfer payments were very, very high and the deficit was at the nearly the lowest level. So this is the idea. Okay. Right now, focus here. Everyone focus here. Whatever the vacancies, if you are preparing, just focus here. This is clear? Give me a thumbs up. So in the current account deficit for the 2023-24 has gone down from 2% to 0.7%. So there is a deficit, but that has gone down. But if you see for the fourth quarter, there is the surplus that has been seen by in the current account, that is 0.6% of the GDP. So data you have to remember. Okay. Now coming to the net inflows of foreign portfolio investment. So that has reached the second highest in the 2023-24, that is at the US dollar 44.6 billion. Now external vulnerability indicators continue to show improvement. The external debt moderated. So in our country, the external debt that we are taking, the debt that we are taking from the other countries have decreased from 19% in the previous year to 18.7% in March 2024. So the external debt has decreased to 18.7% of the GDP in March 2024 as compared to the 19% of the GDP in the previous year, in the March 2023. I hope this is clear. So I hope this is clear. Now short-term debt. Short-term debt with original maturity of up to 1 year in the total external debt has declined to 18.5% in the March 2024. That means we are taking the loans, we are taking the debt mostly for the long period. Okay, so the short-term debt has decreased to 18.5% of the total external debt. So simply 19% of the GDP, this was the external debt that we are taking by the March 2023. That is the previous financial year. Now the external debt has decreased to 18.7% of the GDP in the March 2024. That is at the ending of this financial year 2023-24. Now in this external debt, the share of the short-term loans have also declined to 18.5%. So that is the idea that you need to keep. Okay. So domestic economy, government finance. Now coming to the government finance part, the fiscal consolidation in our country is like the main focus now. The government is focusing a lot in the fiscal consolidation, that is reducing the fiscal deficit, reducing the borrowing requirement of the government. So public debt is the debt that the government is taking. Private debt is the debt that is taken by the people of the country or the institutions of the country, such as the private institutions. So fiscal consolidation, buoyant tax collections. Fiscal consolidation is the focus right now of the government. The buoyant tax collections, good tax collections is also the focus of the government right now, because the fiscal deficit is what? It is the total expenditure minus total receipts excluding borrowing. So the government is focusing on reducing the total expenditure. The government is focusing on increasing the total receipts excluding borrowing. So if the fiscal deficit is reducing, you can understand that the borrowing requirement of the government will also reduce, and that will be very good for our country. I hope this is clear. So fiscal consolidation, buoyant tax collections and improvement in the quality of spending, that the government is also focusing on whatever total expenditure that the government is doing. The government should be focusing on the quality of the expenditure, that the government should be focusing on the assets for the country rather than having the consumption, or rather than having just paying the salaries and not doing the development of the country. So improvement in the quality of the spending is also the focus. These have been the distinguishing features of the union government's fiscal position as compared to the other countries. We are having solid stance, we are having a good stance in the fiscal consolidation. We are focusing on the fiscal consolidation. As per the provisional accounts, the gross, so in the budget also, there is the budget estimates that is released during the presentation of the budget. Then there are the revised estimates. Then there are the provisional accounts. So right now the provisional accounts for the 2023-24 has been released. Provisional accounts means that this is the most recent data. So as per the provisional accounts, the gross fiscal deficit was 5.6% of GDP in the 2023-24 as against the budget estimates. So during the budget estimates, during the start of the financial year of 2023-24, it was assumed or it was estimated that the government will be doing the fiscal deficit of 5.9% of the GDP. While if we see that nearly at the end of the financial year, we did the estimates again and the provisional accounts were released by the government that actually in 2023-24, the fiscal deficit, we have not done 5.9% of the GDP, but we have done 5.6% of the GDP. That means it is lower. The fiscal deficit done by the government in the 2023-24 is lower as compared to the budget estimates. Okay. Now for the next year, the target, the budget estimate is even lower, that in the next year only 5.1% of the fiscal deficit is the target of the government. Okay. So this is the idea. Now gross tax collections have posted double-digit growth. Here you can see that as per the provisional estimates, the total tax revenue that is collected by the government has increased by nearly 13.4%. That is, the tax collections have grown by double digits, driven up by the direct tax collections. So direct tax revenue, so the growth of direct tax was quite high. Okay, as per the provisional accounts, on the expenditure side, the strategy remained towards the capital expenditure, towards the assets of the country. As you know, capital expenditure means that you are trying to increase the assets of your country, or you are trying to decrease the liability, the loans of your country. So you can see here that the capital expenditure in the 2023-24 has grown by 28.2%. That is quite a high percentage. Okay, so the expenditure side, the strategy remained geared towards growth inducing capital expenditure, growth towards the good factors. Okay, growth in revenue expenditure remained down, that is muted at 1.2%. So revenue expenditure has also grown, but revenue expenditure has grown by a very less percentage at 1.2% only. So this is the idea. The central government's debt is projected to fall to 57.1% of the GDP in 2024-25 as per the budget estimate. So you can understand that our central government is focusing on reducing its debt. Okay, so that will fall to 57.1% of the GDP in 2024-25. This is the budget estimate from the 58.4% in the previous year 2023-24. Now coming to the government finance of the state governments. So the states combined gross fiscal deficit to the GSDP, to the gross state domestic product. So the gross fiscal deficit of the states as a percentage of the gross state domestic product. So when we see the fiscal deficit of the central government that the central government has done, that we see as a like 5.6% as a percentage of GDP. But when we see the gross fiscal deficit of the states, we see it as a percentage of the gross state domestic product. Okay, so this is the idea. So the states combined gross fiscal deficit to the gross state domestic product ratio for the 2024-25 has budgeted at 3%. For the 2023-24 provisional estimates, as well as this is going to be continued. This is the budget estimate that in the 2024-25 the GFD, that is the gross fiscal deficit, as a percentage of GSDP will remain at 3%. Alongside this, the state's debt to GDP ratio, debt to GDP ratio has declined to 27.6% by March 2024 from the pandemic high of 31% of the GDP in March 2021. So this debt to GDP ratio is taken as the debt is taken as a ratio for the GDP, the total GDP of the country, not the GSDP, while the GFD, the gross fiscal deficit, it is taken as a percentage of the GSDP. So this is also a difference. Okay, so I hope you will remember these percentages that have been mentioned. Now coming to the financial segment, so here the first chapter will be finished. This is the last point of the first chapter, that is the macro financial risk. So bolstered by the increasing participation of the households, slowly the retail investors, the households, they have started participating in the financial markets. So the mutual funds, like many of the people, they invest in the mutual funds because they do not have much of the idea regarding the stocks, shares and such, right? So the assets under management of the mutual fund has grew by 35.5% during the 2023-24. So this is the data regarding the mutual funds that I found important. Next is analysis of cyber incidents have been reported by the regulated entities. So the scheduled commercial banks, the urban cooperative banks and the NBFCs have reported the data regarding the cyber incidents to the Reserve Bank of India, and as per the data, it shows that 69% of the incidents of the cyber incidents were reported by the scheduled commercial banks. 19% of the cyber incidents were reported by the urban cooperative banks, and 12% of the cyber incidents were reported by the NBFCs of the total incidents. Now the urban cooperative banks had the highest share of incidents in higher risk categories, that is, they are facing the high risk category of the cyber incidents. Okay, cyber incidents, it is the among the types of cyber incidents that have been reported, social engineering incidents constituted the largest share. Social engineering means that the fraudsters, they are trying to manipulate the people to share their information, like they are calling you or they are sending you some link or some message so that you click that link and your personal information will be shared. So this is the social engineering, where the fraudsters are manipulating the people to share their personal details, right? So this is the largest share of the cyber incidents that have happened. Then incidents related to data leakage from the banks or from the urban cooperative banks, from the NBFCs. The application security and ransomware attacks are rapidly rising. The virus attacks are rapidly rising. Now, if from the banks the data is leaked, if the ransomware attack happen on the bank, you can understand that most of these incidents involve the threat actors leaking regulated entities' data, that is the data of the people of the country, and that is also the financial data of the people of the country. So such as the card data, customers' KYC details, KYC documents on the dark web, social media or public platform for sale. So fraudster, they are taking your data through social engineering, as well as there is rapid rise in the incidents related to data leakage, application security and ransomware attack. Now this is a threat on the data of the people with the banks, but still the banks are trying to do they are trying to take the efforts. But you can see that how clear the RBI is and how clearly the Reserve Bank of India is representing the data. They are not trying to hide it. They are trying to show it that, okay, this is the problem in our country, but we are trying to resolve it. So that is a good thing. Now coming to the chapter 2, the chapter 1, is it clear? No. First, the government releases the budget estimates, that is during the time of the reveal of the budget. Okay. Then the government releases the revised estimates. If there is any change in the revised estimates, then the then the government releases the provisional account. Okay. So first, during the release of the budget, government releases the budget estimate, then the revised estimates come, and at last provisional estimates. Clear? I do not want only 3 or 5 people to say clear. There are 85 people in the class. So I want all of you to tell me that, is it clear? Yes or no? We are moving to the second chapter, and this is one of the most important chapter. I will show you, I will take your quiz here also. So let's see how much you will be able to remember here. Clear? Okay, nice. Thank you for the confirmation. Now coming to the first chapter, so that is, coming to the second chapter, financial institutions' soundness and resilience. So here we will see the data regarding the asset quality, regarding the capital position, that is the capital adequacy of the banks, the profitability and the resilience. Here we will also see the macro stress test, that under the medium stress situation, under the severe stress situation, how the banks will be able to maintain their capital position. Will they be or will they not? Okay. So this is the idea. We will also see the interconnectedness of the banks with the other financial institutions. We will see the interconnectedness between the financial institutions. So this is all that is included in the second chapter. That is one of the most important chapter. Okay. Now, scheduled commercial banks. First of all, we are starting with the financial condition of the scheduled commercial bank. Then we will understand the financial condition of urban cooperative banks. Then we will understand the financial condition of the NBFCs. So scheduled commercial bank, their asset quality has improved a lot. Asset quality means that their gross non-performing assets are decreasing, their net non-performing assets are decreasing. Gross NPAs means total NPAs that the banks are having, that they are the NPAs means non-performing asset. The loan that they have given, they are not coming back, or the interest payments are not coming back. So that is the total non-performing assets. Net non-performing asset means from the gross non-performing asset, you have to delete the provisions that the bank has kept. Then you have the net non-performing asset. Okay, so the gross non-performing asset has decreased, the net non-performing asset has also decreased. So the asset quality of the scheduled commercial banks have recorded sustained improvement, and their gross non-performing asset has moderated to a 12-year low in March 2024. So that is a big achievement for the scheduled commercial bank, that their gross non-performing asset ratio has continuously decreased and is at a 12-year low situation at 2.8%, while the net non-performing assets have also recorded at quite low. So the net non-performing assets are also quite low right now at 0.6%. So the gross non-performing asset is at 2.8%, while the net non-performing asset is at a 0.6% in March 2024. So remember these data, they are most important. Okay. Coming to the net interest income of the scheduled commercial bank. Okay, net interest income means that the banks are providing the loans for which they are getting the interest. The banks are taking the deposits for which they have to pay the interest. So banks are getting the interest. Banks are getting the interest for the loans that you are taking, as well as banks have to pay the interest also. Let's say banks are getting 100 rupees in the interest, while the banks have to pay rupees 10 in the interest for the depositors. So banks are getting rupees 100 interest from the borrowers, and the banks are giving rupees 10 interest to the depositors. So that means net interest income of the bank is rupees 90. So net interest income means how much the interest banks are getting minus how much interest the banks have to pay. So this is the net interest income of the scheduled commercial bank. This has increased during the 2023-24 with a surge in trading income. Their trading income has also increased, like they are trading in different securities, so that income has also increased, augmenting other operating income. As the need for additional provisions fell, so because the gross non-performing assets are reducing, so that means their provisions that they need to keep is also decreasing. Okay, due to the depleting stock of NPAs, because their NPAs are decreasing, so their provisions requirement is also decreasing. Profit after tax, because of all of these scenarios, the profit after tax, that is the profit that is left with them after the tax that they have paid, has increased by 32.5%. Okay, so the profit after tax of the scheduled commercial bank has rose by 32.5% in spite of large increase in operating expenses. Okay, their profits have increased, their the trading income has increased, their net interest income has increased, their trading income has increased, their provision requirements have decreased. With all of these, their operating expenses is increased. So their income has increased, but their expenses has also increased, but still the profit after tax has increased by 32.5% for the banks. Their return on asset remained strong at 1.3%, and their return on equity has remained strong at 13.8% respectively in the March 2024. So I hope this is clear. Do not worry about that, Priya. We will see. I have brought a slide. You will see that, okay? So this is return on equity 13.8%, while the return on asset has remained strong at 1.3%. So this is the idea. So simply the idea is that the interest income has increased of the banks. The trading income has increased of the banks. The provisions that the bank has to give has declined, minus their operating expenses. So these are the profits. This is the profit. So this is interest income and trading income has increased immensely, while their operating expenses has also increased, but not by much. Means they are not comparatively to the increase in income. So their profit is happening, and the profit after tax has increased by 32.5%. So profit that they have got after paying the tax, so that is profit after tax, that has increased by 32.5%. Now coming to the next point, their deposit growth. So their deposits are growing by 13.5% in the that is the data of the March 2024, that the deposits of the scheduled commercial bank has increased by 13.5%, but the credit growth, the credit of the scheduled commercial banks has increased by 19.2%. So you can understand that if we see the credit to deposit ratio, the credit or the credit growth has been higher than the growth in the deposit. So there is a growing gap between the credit and the deposit growth. This is reflected in a rising, there is a rising credit to deposit ratio, because the credit growth is happening faster than the deposit growth. Still, like the credit is, let's say, if you see the credit to deposit ratio, which has been on the ascent since September 2021, the credit to deposit ratio has been rising to peak at 78.8% in the December 2023 before moderating to 76.8% at end March 2024. But still the credit growth is faster than the deposit growth in our country. So that is the credit to deposit ratio is 76.8%. That is, with a deposit of 100, there is the credit that is given is 76.8% near. So I hope this is clear. Now the next point is that the projections of SCB's GNPA ratio, like if the currently the GNPA is 2.8%, okay, for the scheduled commercial banks in March 2024. Now it has been said that what will be the GNPA, that we have to estimate the GNPA for the 2025. So in the baseline scenario, in the normal scenario, it has been said that the GNPA is actually going to decline to 2.5% by March 2025. That is, in March 2025, in the normal baseline scenario, the GNPA ratio will be around 2.5%. In the normal situation, in 2025, March 2025, we will see that the GNPA has declined to 2.5% in the country of the scheduled commercial bank. But if there is a medium stress situation, if there is a stressful situation that is coming to the banks, then the GNPA ratio will be 2.8%. That is same as this year. So in the medium stress situation, the GNPA ratio will be 2.8% in March 2025, and in the most severe stressful situation, the GNPA ratio will be around 3.0% in the March 2025. 3.4%, my bad. It will be 3.4%. The GNPA ratio will be, or the GNPA will be 3.4% in the March 2024. In the March 2025, in the most stressful situation, in the severe stressful situation. So I hope this is clear that in the baseline situation in March 2025, in the baseline situation, the GNPA ratio will be 2.5% for the SCBs, for the scheduled commercial bank. In the medium stress situation, the GNPA ratio will be 2.8%. That is same as this year. In the most stressful situation, severe stress situation, in the March 2025, the GNPA ratio will be highest at 3.4%. So this is the idea. So here you can see that the GNPA ratio of all the scheduled commercial bank may improve to 2.5% by March 2025 under the baseline, under the normal scenario that is expected. Okay. Now coming to the next, the share of large borrowers in the loans and GNPAs. So in the total advances by the scheduled commercial bank, the share of large borrowers is 44.4%, while in the gross NPAs of the scheduled commercial bank, the share of the large borrower is 47.6%. Okay, so you can understand that the large borrowers, they are taking a lot of loans from the scheduled commercial banks. Their share in the gross advances is 44.4%. Their share in the gross non-performing assets is 47.6%. So the gross non-performing asset, if we see only for the large borrowers, this is around 3% in the March 2024. I hope this is clear that the gross non-performing asset for the scheduled commercial banks for all the categories is the gross non-performing asset for the scheduled commercial bank for the period of 2024 March was 2.8%. But if we see for the large borrowers, only for the large borrower segment, the scheduled commercial bank has the GNPA ratio of large borrowers at 3.0% in March 2024. But you can see that it is declining. The GNPA ratio is continuously declining. Okay. Now, as at the end of March 2024, only one of the top 100 borrowers accounts was classified under the NPA category. So that is also good that only one out of the 100 have defaulted or have the loan under the NPA category. Now, coming to the capital to risk weighted asset ratio. So this we have discussed, capital to risk weighted asset ratio. So that is capital to risk weighted asset. So if the banks are giving the loans, so that is the asset for the bank. The banks are giving the loans, that is the asset for the bank. Against these loans, there is some risk also, that what if this loan doesn't come back. So some loans have 0% risk, that is the loan that is given to central government. Some loans have 100% risk, such as the loans that is given to agriculture segment or something. So these are the risk weights with the asset that has been given, with the loan that has been given. So according to the risk weighted assets, the bank has to keep some capital so that it maintains the solvency of the bank. So this capital, that the minimum capital requirement or the minimum capital to risk weighted asset ratio that the banks have to keep is 9%. Okay, this is the minimum CRAR. This is divided into tier 1 and tier 2. Tier 1 is the most liquid capital, and in this you have the CET1, that is the common equity tier 1 capital, that is among all the capital, this is the most liquid capital. So tier 1 is the liquid capital, you can say, and the CET1, that is the common equity tier 1, that is the reserve assets of the bank or the undistributed profits of the bank, that is the most liquid capital that the bank has, that the bank can use during the any kind of distress situation. Okay, now tier 1 capital has the CET1 and the AT1 capital. So CET1, it has to be kept at 5.5%, AT1 it has to be kept at 1.5%. So tier 2 capital has to be kept at 2%. Okay, so this is the idea that the capital to risk weighted asset ratio, that is 9% the banks have to keep. This is the minimum requirement. This is the minimum requirement by the Reserve Bank of India, that the banks have to keep the CRAR of 9%. Out of this 9%, tier 1 capital, that is CET1 5.5%, AT1 1.5% and tier 2 capital 2%. Tier 2 capital is actually the assets of the bank that the bank doesn't use during the normal situation because the bank cannot sell its infrastructure, right? Now in this CRAR, if you add the CCB, that is the capital conservation buffer, so CRAR is 9%. Banks have to keep some buffers also, that is at 2.5%. So in total, the bank have to keep 11.5% of the capital. Okay, so now the scheduled commercial banks are maintaining 16.8% of the capital, that is way higher than the 11.5% of the minimum requirement. So 11.5%, 9%, that is plus 2.5%. So this is the minimum requirement by the Reserve Bank of India, but the banks are actually keeping with themselves the 16.8%. That is quite high, that is quite good. So now this is a question for you. I hope you know the percentages now. So this is a test for you. First of all, I need like rapid fire answers. Start with baseline situation is normal situation where there is no stress, the economy is working very smoothly and very nicely. Okay. Now GNPA ratio. This is for the scheduled commercial banks for the March 2024. So GNPA ratio was how much? What was the percentage? Tell me fast. 2.8%. That was 12-year low. 12-year low. NNPA was how much? 0.6%. Very good. CRAR of the scheduled commercial bank. How much? 16.8%, very good. CET1, it is the common equity tier 1. So we have discussed this in highlights that it is 13.1%. Okay, is it 13.1%? Do I remember it correctly? Okay, so PCR, the provisional coverage ratio for the March 2024 we are discussing. So PCR, this is the provisional coverage ratio that if you have the GNPA of let's say 100 rupees, how much of the provisions the bank has. So currently the scheduled commercial bank has the provisions of 76.4, that is the provisioning coverage ratio is 76.4%. That is out of 100 of the gross non-performing asset, they have the coverage of 76.4% through their provisions. So provisional coverage ratio is 76.4%. Provisional coverage ratio means that if you have the GNPA of 100, how much provisions you have, how much provisions the bank has to cater to that GNPA. Okay, so if you discuss, profit after tax is 32.5%. I hope you remember this. Credit growth is how much? Credit growth was around 19.2%, right? Deposit growth was 13.5%. Okay, so this is the data. That is 2.8%, 0.6%, 16.8%. CET1 was 13.9%. Sorry, it was 13.9%. CET1, I have told you what is CET1. It is the part of tier 1 capital. So CET1 is the most liquid capital. So if the banks are keeping 16.8% as CRAR, they are keeping 13.9% of the CET1, that is tier 1 capital. I hope this is clear. Now PCR is 76.4%, that is if the banks are having the NPA. So what is provisions? This is a question that was asked to me a lot of times. So provisions represent funds that is put aside by a bank, by a company to cover anticipated losses. So CRAR is usually for the unanticipated losses so that you do not become insolvent. So the capital to risk weighted asset ratio, this is kept to maintain your solvency. This is kept for the unanticipated losses. But some losses are already anticipated by the bank, that if they are giving loan to you, they anticipate that okay, half of the loan can go into losses. So the banks already anticipate some of the losses, so they keep some provisions against these losses for the future. In other words, provision is the liability of uncertain timing and amount. Provisions are listed on a company's balance sheet under the liabilities section. So loan that you are giving is asset, but from the loan you are anticipating that okay, some losses can happen from this loan, so you are keeping some provisions. Let's say I am giving the loan of 100 rupees, I am keeping the provision 5 rupees or such. Okay, so all the loan accounts, they do not become NPA, only like some of the loan accounts become NPA or the gross non-performing assets. So out of the gross non-performing assets, you already have the provisions of like if the gross non-performing asset is 100 rupees, you have the provision of 76.4 rupees. That means your provisioning coverage ratio is 76.4%. Now I hope this is clear. Is it clear? Profit after tax 32.5%, credit growth 19.2%, deposit growth is 13.5%. Now there is a point that I want to show you, okay, that there was a housing finance company. So there was a merger that happened, okay, with the banks, with the scheduled commercial bank, there was a merger of the NBFC that happened. So the credit growth stood at 16% for March 2024 net of merger. After the merger happened, the credit growth of the bank. Otherwise, if only credit growth has been asked, if only credit growth of the bank has been asked, you will say 19.2%. But if it is written net of merger, then you will say that the credit growth net of merger of the scheduled commercial bank was 16%. I hope this is clear. That there, like in the scheduled commercial bank, there was a merger of NBFC happened. So net of merger. So net of merger, the credit growth stood at 16% for March 2024. In the deposit growth, net of merger, the deposit growth stood at 13.2%. Otherwise, if only the deposit growth or credit growth has been asked, you will write the main percentages 13.5 or 19%. But if it is written net of merger, then you have to specify. Understood? Yes, NBFC was merged with the bank now. Okay, clear till now? Coming to, so this was the highlights that we have discussed. So the CRAR of the scheduled commercial bank is 16.8%. The CET1 of the scheduled commercial bank is 13.9%. Gross non-performing asset is 2.8%. Net non-performing asset is 0.6%. Now coming to the macro stress test. So what happened that the Reserve Bank of India or the subcommittee of the FSDC, they did a macro stress test. Okay, in the macro stress test, what happened? That there is a stress test that happens that in the future, let's say in March 2025, the new financial year is going to finish in March 2025. So what will be the capital situation? What will be the situation of the capital at March 2025? So what will be the situation of the capital in March 2025? To see that, there is a macro stress test that happens that in the baseline or in the normal situation, what will be the CRAR of the banks? What will be the capital adequacy or what will be the CRAR of the banks in March 2025? In the medium stress situation, what will be the capital of the banks in March 2025? In the severe stress situation, what will be the capital of the bank in the March 2025? So there is the macro stress test that happens. So under the baseline scenario, see, first of all, there is the 46 major banks that were taken on which the test has happened, or using their data, the test has happened. Okay. So under the baseline scenario, so macro stress test for credit risk reveal that scheduled commercial banks would be able to comply with minimum capital requirements of 9% of CRAR plus 2.5% of the capital conservation buffer. So 11.5% of the capital the banks have to maintain. So it has been said by the macro stress test, or using the macro stress test, the Reserve Bank of India is saying that the scheduled commercial banks will be able to maintain the required capital, minimum required capital, with the system level CRAR in March 2025 projected at 16.1% in the baseline scenario. In the baseline scenario, the CRAR that the banks will have will be around 16.1% in the normal, in the baseline scenario in March 2025. In the medium stress scenario, the banks will be able to have 14.4% of the CRAR in the medium stress scenario. Okay, 14.4% of the CRAR the banks will be able to maintain in the medium stress scenario in March 2025. In the severe stress scenario, in the major stress scenario, the banks will be able to keep 13.0% of the CRAR with themselves in March 2025. So that means in the coming year, in the March 2025, at the end of the year, the banks will have enough of the capital that is higher than the minimum capital requirement of the banks. I hope this is clear. I hope this is clear that under the baseline scenario, the aggregate CRAR of the 46 major banks is projected to be at 16.1% by March 2025. In the medium stress scenario, the CRAR may go down to 14.4% and 13.0% under the severe stress scenario by March 2025, which is still above the minimum capital requirement. And let me tell you that this is only a test that the Reserve Bank of India or the subcommittee has done. It is not patthar ke lakir or something written in stone. This can change, right? So now one thing that here you will say that CRAR for March 2024 is mentioned at 16.7% and not 16.8%. So why is it so? Because here the CRAR is for all the banks, for all the scheduled commercial banks, but here when we are doing the macro stress test, the CRAR is only for the 46 major banks. Okay, so when we say the CRAR for all the scheduled commercial banks for in March 2024, so that is how much? 16.8%. But when we say the CRAR for the 46 major banks for which the macro stress test has happened, so with them in March 2024, the CRAR that they had was 16.7%. Similarly, when we say the CET1, it was 13.9% if we talk about all the scheduled commercial bank in March 2024. But if we talk about the CET1, that is the common equity tier 1 capital that the 46 major banks had, that the 46 major scheduled commercial bank had, so it was 13.8% in March 2024. So that means when we are talking about all the scheduled commercial bank, it will be 13.9% CET1 in March 2024. But if we talk about only the 46 among all the scheduled commercial banks, so CET1 will decrease by 0.1%. So here you can see the CET1 capital ratio of the select 46 banks may decline from 13.8%. So otherwise CET1 for March 2024 is 13.9%. But if you see the CET1 for 46 scheduled commercial bank, it is 13.8% in March 2024. Now it has been said that in the baseline, in the normal situation, the CET1 in the coming year is expected to decline to 13.4% under the baseline, under the normal scenario. Okay. Now coming to the primary urban cooperative banks, let's move forward with the urban cooperative banks. So here the credit growth was 5.7% in March 2024 for all the urban cooperative banks. For all the urban cooperative banks, the CRAR, that is the capital to risk weighted asset ratio, was even higher than the scheduled commercial bank. So they maintained the CRAR of 17.5% in March 2024. So the capital position of the urban cooperative banks have been continuously improving the post-pandemic period, with their CRAR increasing to 17.5% in March 2024. The GNPA ratio was around 8.8%. Their NNPA ratio is around 2.8% in March 2024. The provisioning coverage ratio for the urban cooperative banks is 70.1%, that is still good, and the ROA, that is the return on asset, for the urban cooperative banks is 0.8%, while the return on equity is 7.9%. Okay, so these are the data for the primary urban cooperative bank. Now I am giving you a homework question, like for the scheduled commercial bank, I have made a table and I have made you revise. Similarly, in the comment section, you have to write for the urban cooperative banks. For the urban cooperative banks, you have to write down the CRAR, the GNPA, the NNPA, the ROA, the credit growth also. Not the credit, yes, credit growth, as well as the PCA, provisioning coverage ratio, PCR. Okay, so these are the percentages that you have to write in the comment section. Similarly for the NBFCs also. Now the NBFCs, their NNPA has declined to 1.1%. Their GNPA has declined to 4.0%. Their provisioning coverage ratio, the provisioning coverage ratio is at the 72.1%. Okay, so their GNP, the GNPA ratio of NBFCs, including those under resolution, continued its downward trajectory. That means GNPA is declining to 4.0%. NNPA has declined to 1.1%. Now the CRAR of the NBFCs stood at 26.6%. So the minimum CRAR requirement of the NBFCs is 15%. So you can understand that the minimum CRAR requirement of the NBFCs is 15%, but they are actually maintaining the CRAR of 26.6%. So that is very good. The ROA of the NBFCs, the return on asset of NBFCs is 3.3%. Okay. Now next is sectoral credit data for NBFCs. So the NBFCs gross advances was 17.9%. Okay. So this is the year-on-year growth that has happened in the credit advances, that is 17.9%. Now there was a macro stress test that happened for NBFCs also. So for NBFC also, you have to make like in the comment section, you have to first tell about the urban cooperative banks, and then in the next comment you have to tell about the NBFCs, that what is their GNPA, their NNPA, their CRAR, their ROA. So these are the 4-5 data points that you have to write. Okay. Coming to the credit risk in NBFCs. So there is a system level test that happened on the NBFCs, and you do not have to remember this data. It's not like that you have to remember or cram this data, but the idea is that in the baseline scenario, still the NBFCs in the baseline, in the normal scenario, the RBI is expecting the CRAR to go down from 26.6% in March 2024 to 21.7% in the March 2025. So as per the macro stress test, it is expected the CRAR in the coming year will go down. Okay, the GNPA ratio is also going to go down. The GNPA ratio will go down from 4% to 3.5%, and the NBFCs, the number of NBFCs failing will be 8. In the medium stress situation, the CRAR will not be much affected, 21% around, and the GNPA will increase, number of banks failing will increase. In the high risk scenario, in the severe risk scenario, you can understand that still the NBFCs are going to maintain the higher CRAR as per their minimum requirement. So minimum requirement of CRAR for NBFCs is 15%, but even in the high stress scenario, the NBFCs are going to maintain 20.8% of the CRAR. That is higher than the 15% of the minimum requirement. In the March 2025, they are going to maintain the higher CRAR. In March 2025, even in the severe stress scenario, they are going to maintain the higher CRAR as compared to the minimum requirement of 15%. They are going to maintain higher than this. So this is the idea. Now coming to the last few topics for today, that is starting with the insurance sector. At the end of the session, I will take it, Ritika. Okay, so coming to the insurance sector. So in the insurance sector, there is a solvency ratio, that is 150%. So solvency ratio of an insurance company assesses the ability of the insurer, ability of the LIC, GIC to meet its obligation. So the insurance sector or the insurance companies, in total, they have to maintain 150% of the solvency ratio. That means if their liabilities are of 100 rupees, if the claims that can come is of 100 rupees, they have to maintain the assets of 150 rupees. Okay, so this is solvency ratio. So as per the IRDAI, there is the minimum solvency ratio, that is 150%, and the insurance companies are maintaining this minimum solvency ratio. Okay, so that is the idea. The minimum solvency ratio requirement set by the IRDAI for insurance companies in India is 150%, and the insurance companies are maintaining this. That means they are keeping higher assets as compared to their liabilities, so that they have no problem in that. Okay. Next is coming to the contagion and the network analysis. Okay, so network analysis, by the name itself, it suggests that we are trying to see the network between the different financial institutions. Okay, so here network analysis indicates that the total outstanding bilateral exposures between the financial institutions are expanding. That means the connection between the financial institutions are expanding, with scheduled commercial banks holding the largest share of the connection between the different financial institutions. So the network analysis says that there is the connection that is increasing between the financial institutions. Now the contagion analysis explains that, let's say that if the top 5 banks are failing, or if the top 5 NBFCs are failing, so will it affect the other banks or other NBFCs in the country? So the contagion analysis uses the network technologies, uses the network analysis to estimate the systemic importance of different financial institutions. So here we are trying to see that the magnitude of the interconnections that the failing bank has with the rest of the banking system. So here you can see the test has happened. You do not have to remember the data. The idea is that if the top 5 banks are failing, it will not let the other banks, like it will not affect the other banks. It might affect the other banks, but the other banks will not fall. So this is the idea. That is, a simulated contagion analysis shows that losses due to failure of 5 banks with a maximum capacity to cause contagion would not lead to failure of any additional bank. So the top 5 banks that are most connected with the other financial institutions, so they are they have the maximum capacity to cause contagion, but still, if these top 5 banks that are most connected, even if they are falling, it will not affect the other banks. Number of banks defaulting due to the failure of these 5 banks will be 0. Similarly, the top 5 NBFCs that have the highest of the, they have the maximum of the capacity to cause the contagion. So these are the top 5 NBFCs. These are not like the in the asset size or something. They are the top 5 NBFCs that are most connected with the other institutions. So if these 5 NBFCs, if these top 5 NBFCs that have the maximum capacity to cause contagion, even if these 5 NBFCs are failing, the other NBFCs will not fail. Number of banks defaulting, the other banks will not fail. See, NBFCs defaulting will not be much problem, but the banks defaulting will be. So the banks, we have seen it in the case of the banks, that even if the top 5 NBFCs that have a lot of connection, that have a lot of interconnection with the banks, even if these top 5 NBFCs are failing, it will not affect the banks. I hope this is clear. So now coming to the chapter 3, in which we have to discuss the regulatory initiatives in the financial sector. So first of all, in the global area, if you see, the main focus is on the climate change, because the climate is causing a lot of risk. Okay, previous year there was a lot of heat waves that were going on. In this year also a lot of heat waves are going on, due to which the agriculture, like the food production is becoming very volatile, the food prices are becoming very volatile. So because of the climate change, it is affecting the economic structure of the different countries. So this is the global areas that the focus is on by the global regulators. So as the global economy navigates the heightened uncertainty, the policymakers have maintained the focus on enhancing the resilience of the financial system. So the focus is also on the financial system, that we have to maintain the resilience of the financial system around the globe. Consolidating the improvement in the regulation and supervision, the global regulatory efforts are also prioritizing the mitigation of the risk that is arising from the climate change. There are much of the risk that are coming from the climate change, so that we have to reduce. Leveraging advancement in financial technology, so we have to further advance in the financial technology, as well as we have to use the advancement in the financial technology dealing with the cyber threat. So there are the 3 key areas that have been discussed in regards to the global regulatory initiatives. So the global authorities, they are focusing on the risk coming from the climate change, the resilience of the financial system, as well as on the cyber threat, that we have to focus on defeating the cyber threats, or we have to focus on reducing the cyber threats. So these are the focus areas at the global level. But see, there are many of the regulatory initiatives that have been given in the global level, but we have to focus more on the domestic regulatory initiatives. Most of these regulatory initiatives we have already discussed, but I will suggest you that go through the chapter 3. Okay, because it is like providing you a summary that what the different regulators have done in the previous year, in the previous financial year 2023-24. So there is the guidelines that have been released by the Reserve Bank of India in regards to the voluntary transition of the small finance bank to the universal banks. So that we had already discussed in our class, right? These all topics, if I take one by one, these are the topics, 50 minutes, 40 minutes, 30 minutes, I will take 2 or 3 hours for discussing these topics, but they already have been discussed in the in the Finance 360 sessions. In the Finance 360 degree sessions, we have already discussed these major guidelines of the Reserve Bank of India, of the RBI, SEBI and such. Okay, so voluntary transition of small finance bank to universal bank, this is a regulatory initiative of the Reserve Bank of India. Reserve Bank of India government securities lending directions that the RBI released, margining for non-centrally cleared OTC derivatives. So this is also a guideline that the RBI has released. Next is introduction of beta version of T+0 rolling settlement cycle. So this is something that the SEBI has done, the guidelines that the SEBI has released. Investments in AIFs, omnibus framework of SROs for regulated entities, credit or investment concentration norms, as well as framework for dealing with domestic systemically important banks. So these are some of the regulatory initiatives that the regulators in our country has taken. So I hope this is clear. You have to read it, go to the chapter 3 and try to read this, or if you already know about it, then there is no requirement, right? With the current deposit insurance, so there is the DICGC, that is the insurer of the deposits in the banking system. So DICGC is the one that is the wholly owned subsidiary of the Reserve Bank of India. DICGC ensures the amount that we are depositing in the banks. So till 5 lakh of the amount, it is insured by the DICGC. So with the current deposit insurance limit of 5 lakh rupees that is insured by the DICGC, nearly 97.8% of the total number of deposit accounts are insured, are fully insured. Okay, 97.8% of the deposit accounts are completely insured. Of the total deposits of 218.23 lakh crore, 43.1% of the deposits are insured, because the deposits are more than 5 lakh, that you can understand. There are much of the deposits that are more than 5 lakh rupees. So that's why the total deposits that are insured is 43.1%. So this is the data. Now coming to the systemic risk survey. So that is the last point that we have to discuss today. Yes, yes, yes. So if if the banks or the NBFCs are failing, then yes, if the banks or the NBFCs are failing, as per the contagion analysis, if the top 5 connected banks are failing, or if the top 5 connected NBFCs are failing, for sure they are going to affect the other banks. But the other banks are not going to fall because of this reason. Okay, yes, it will affect the other banks for sure. Their CRAR might reduce, their NPAs might increase, but the other banks will not fall. So this is what number of banks defaulting will be 0, or the number of banks getting into solvency will be insolvency will be 0. So that is the idea. Okay. Now coming to the SRS, that is the systemic risk survey. So this is the last point that we have to discuss today. So in the latest round of systemic risk survey was conducted in May 2024. Okay, and the systemic risk survey results were released in with the FSR, with the financial stability report. So in the FSR, there is the systemic risk survey results that have been released in June 2024. So SRS was conducted in May 2024, but the results came out with the FSR in June 2024. So the 26th round of Reserve Bank systemic risk survey was conducted during May 2024 to solicit to get the perception of the experts, that what they are thinking, how they are perceiving the country, and the macroeconomic situation of the country, okay, including market participants on major risk faced by the Indian financial system. So the panelists, there were approximately 46 panelists, okay. So panelists perceived the global spillover risk have receded. That means global spillover risk has receded means that on our economy, the global effects have come down. Global spillover effects have come down. If you compare our economy during the COVID time and during recent time, so during COVID time, the global spillover effect was very high. The global effect on our country, the global negative effect on our country was very high, because in the global area there was much of the trade was nearly stopped, or trade reduced a lot, the traveling, the tourist stopped coming. So the global spillover risk was very high during that time, which have reduced now. Also, assessment of the macroeconomic risk witnessed a marginal decline. That means macroeconomic risk in our country has declined. So simply the panelists perceived. So the panelists have given their idea that what is happening to our economic situation. So systemic risk survey, major risk groups have been identified. So that is global risk to our country, macroeconomic risk to our country, financial market risk to our country, and institutional risk to our country. How much they are going to affect. Okay. So here, if they are in the 6 to 8 category, they are high, 4 to 6 category medium. That means global risk, they have come from the high risk to medium risk category. That means global risk, global spillover risk, or global risk affecting our economy have reduced. Okay, so that is the risk perception has declined, that the global risk will affect our country, so that has declined. Macroeconomic risk also, you can see it has declined, but it is still in the medium category. The financial market risk, it has remained constant, or the institutional risk has also remained constant. So they are in the medium risk situation. Okay, so these are some of the data that you can see. Now in the global risk, what is the global risk? Global growth risk, that there is risk to the global growth, there is risk of the funding of the external borrowings, there is risk of the commodity prices at the global level, there is banking turmoil risk, like the American banks, some of them failed or such, monetary tightening risk in the advanced countries. So you can see that most of them have come into the medium category, but still the commodity price risk has remained in the high risk category. Okay, so due to that, there are still some global risk, but that have reduced, because most the global growth risk have reduced and such. Simply the idea is that the panelists have given their decision, and before the global spillover risk was at the high risk category, but now it has come down to medium risk category. So this is the systemic risk survey that happens, in which the market experts or the market participants, they give their ideas that, okay, what do they think that what is happening and how our economy can be affected due to different risk. So as per the different panelists, the decision has been given that the global risk has receded, has come down. The macroeconomic risk in our country has also gone down. The financial market risk has remained stable, as well as the institutional risk are also same as before at the medium level. So these are some of the decisions that they have taken. Now what is global risk? So that comes from all of these sub-variables. Macroeconomic risk, these come from these sub-variables. Okay, so you can understand that the climate risk, as per the panelist, the climate risk is at the high risk category, that is also increasing. The climate risk is increasing, as well as the equity price volatility. This risk is also at the high risk category and it is increasing, that you can see. Okay, now there is not much left to explain here, but I hope you have understood. Now the homework that I have given to you is what? That you have to write one comment regarding the UCB's data, like the table that I had given to you for the scheduled commercial bank. You have to tell me the data for urban cooperative banks. You have to tell me the data for the NBFCs. Okay, the systemic risk survey, it is important from the understanding perspective because a question came from the inflation, the SPF, sorry, Survey of Professional Forecasters. So in the previous year, in the RBI Grade B examination phase 1, there was a question from the Survey of Professional Forecasters. So I have brought you the basic idea of the systemic risk survey. So you can read that, okay, which risk has increased particularly. So that is the risk that is in the macroeconomic risk category. This has gone down, as well as the global risk has gone down. So no risk has increased for our country. That is a very important point, that as per the panelists, no risk has increased for our country. The risk has decreased, especially the global risk has come down from high risk category to low risk category. Now before leaving, I want you all to answer this homework question, as well as I want to show you the website. So if you go to edutap.co.in, if you want to know more about any particular examination, you can go to the free material section, to the blog section here. If you go to the end of the page, you can see that you can get the exam information regarding any of the examination, right? So if you want to get the information regarding the RBI Grade B, so you can get the information about the RBI Grade B exam analysis and the eligibility criteria, cutoff marks, as well as if you want to know about the strategy for the RBI Grade B, the different components are provided here, so you can know the strategy for the different components. Even if you want to get the success story, so you can see that the success story you can get from here. So like that, how the aspirants were able to achieve their dreams. So it has been mentioned here that how like what strategy they have adopted, how they were able to achieve their dreams. Okay, even if you want to know about the courses, you can go back to the main page, and if you want to know about the courses, RBI Grade B, SEBI Grade A, so you can know from here. You can know about the courses and you can see the off that is going on also from here. Okay, so this is it from my side. I hope you enjoyed the session. Sorry. No, actually see, ROA and ROE, in the ROE, we do not deduct the debt of the company. So let's say the banks are getting the returns. So whatever returns that they are getting on their assets, on their equity, we will see that. Okay. So that is the total returns that the banks are getting. In the ROA, this actually showcases the true picture of the bank. That in the ROA, we take the returns that the banks are getting minus the debt of the bank. The debt that the bank has taken. So ROA is actually return on asset, that is the returns minus the debt of the bank. So ROA is calculating by deducting the debt of the bank, that is the liability of the bank that the bank has to return. So this is a part of the static concept. I'm not going too much in depth because then you will require the formulas of this. So that is not required here. ROE is just the return on equity. This is the overall returns that the banks are perceiving. But return on asset provides the true picture, because in this return on asset, the banks have to deduct their debt scenario. Okay, that how much debt they have taken. Sorry, I'm fumbling now. I'm not feeling well today, but I had promised this session, so I had to take the session. But I hope that I was able to convey the things clearly. I know I fumbled at some places, but I hope the things are clear. So in the ROE and ROE is simply the overall returns. ROA is the returns minus, like after deducting the debt of the company. Okay. Yes, Priyanka, you can say. So the gross fiscal deficit is what? It is the total expenditure minus total receipts excluding borrowing. So if the gross fiscal deficit is 20 crores, that means this is the total borrowing requirement of the government. Okay. Thank you so much. Do tell me in the comment section if you like the session, as well as I want you all to tell me the homework question, that what is the percentages for the UCBs and what is the percentages for the NBFCs, because these are the chapter 2, that is the percentages that have been provided to you. These are most important from the examination perspective. So these percentages that I have asked you in this table format. So I have asked you from the scheduled commercial bank perspective. Now you have to tell me in the comment section from the urban cooperative bank and from the NBFC's perspective, because these percentages are most important. Okay. Data is too much, but these are the important data that you have to focus on. Okay. I will take a revision session of FSR. Maybe not very soon, maybe in the coming Saturday, next Saturday or next Saturday, okay? But I will take a revision session on FSR, so you do not need to worry about it. For now, remember these data that I have given in the table format, and for the UCBs and NBFCs also, okay? So thank you very much everyone for joining the session. See you on Tuesday now. Thank you everyone. Do tell me in the comment section that if you like the session,